Tom Wheelwright, CPA. Tax-free wealth. How to build massive wealth by permanently lowering your taxes. We all know the old saying, there are two constants in life, death and taxes. If you're like most people, these things are equally scary, so you put all your effort into either delaying or ignoring them. While you may have to come to terms with death in your own way, you'll be happy to know that you don't have to live in fear of tax season. Taxes can be understood by anyone, and the tax laws, while they can seem a bit complicated, actually exist to help you save money. That's right, taxes are your friend. You see, taxes are the government's way of encouraging people to do what's best to keep the economy running. If you're doing what the government wants, then you'll be rewarded by paying less in taxes. Everything you do either raises or lowers your taxes. It all comes down to your facts. These are the circumstances related to how you do business, how you invest, and your personal activities. If you change your facts to be in line with what the government is encouraging, then you will save money on taxes. It is as simple as that. In these blinks, you'll learn how to change your facts to greatly reduce your taxes and save money for yourself, your family, and your business. These tricks are all provided by the tax laws of most modern first world countries. Whether you're from the US, Canada, Australia, or Europe, you can start getting these laws to work for you today. Let's find out how. Make sure you're earning the right type of income. Did you used to earn pocket money as a kid? Maybe you got money from your parents for shoveling snow or cleaning the windows. Chances are you didn't really care where the money came from, you were just happy to have it and spend it. Well, you're not a kid anymore, and you're probably looking to earn a lot more than pocket change. There are different ways you can get money, and they are not taxed equally. There are 4 types of earners: employees working for a salary, the self-employed, big business owners, and investors. It is these last 2, businesses and investors, which are taxed at the lowest rate. Think about it. What does the government want? More jobs are good for the economy. New jobs are created by businesses and entrepreneurs, so the government rewards these people by lowering their taxes. What else does the government want? Affordable housing. Once again, governments offer huge tax breaks to real estate investors because they want to encourage that sort of behaviour. You may be thinking, oh, that's great, but what if you're on the employee or self-employed side of the spectrum? If you want to get the tax benefits, you're going to have to shift your income into one of the other areas. It's not as hard as it seems. Thousands of people all over the world take courses in business or investment and change the way they earn. Now let's look at different ways you can receive income. Think of your income as if it were filling up one of 5 buckets, each with a different amount of holes through which money can be lost to tax. The first bucket is earned income. This one has the most holes in it. You're going to lose a lot of money to income and employment taxes. Try to stay away from this bucket. Let's call the next one your ordinary income bucket. This is income you might be getting from your pension or retirement plan, or whatever income won't fit into the other buckets. This still receives the highest income tax, but it doesn't get the employment tax like the first bucket. The next bucket is for investment income. Things like capital gains, interest and dividends. This income is taxed at a much lower rate, and in some cases, not at all. The fourth bucket is for gifts or inheritance. In most countries, the tax is paid on the side of the person giving the money, so nothing is lost when it lands in your bucket. Finally, you have the passive income bucket. This is money that you receive from a business or investment which isn't managed by you personally. This is taxed at a regular rate, but there are many ways to reduce this amount. Which brings us to the topic of the next blink. How you can patch the holes in those buckets using a miraculous little thing called deductions. Almost anything can be deducted. Life isn't fair, and neither are taxes. Sure, you can complain about it, but what's that going to do? Better is to join the side that's receiving the benefits. As you saw in the previous blink, that means becoming an entrepreneur or investor. Once you start a business or make some smart investments, a whole world of money-saving options opens up in the form of deductions. You see, in the right circumstances, with the right facts, almost anything can be deducted. The government wants to encourage individuals who put money into the economy with the goal of producing, not consuming. This means that if the purpose of the expense is to produce more income, you can deduct it in your taxes. Do you like going out to dinner? Invite a business partner and discuss growth opportunities, and it suddenly becomes a deductible expense. Love travelling to New Mexico? Invest in property there and claim all your travel expenses. Get your family involved in the bookkeeping for the investment, and they can travel free as well. But there's one type of deduction which sits above all the others. The king of deductions. Depreciation. Depreciation is like magic. Say you own some sort of physical asset that produces income. This could be a building or machinery, or even your car if you use it for work. You can actually deduct a portion of the cost of that building every year for a certain number of years. It costs you nothing, so you're making money appear from thin air. Magic. To fully take advantage of the miracle of depreciation, you should make sure you're deducting as much as you can. For example, when calculating the total cost of a building you own, don't forget about any landscaping or improvement costs. Car parks, fences, even the things inside it like floor coverings and cabinetry. These can be deducted separately, and because they depreciate faster, you will get a bigger deduction than if you treated the whole building as one cost. There is one important trick to make sure that you get the most out of your depreciation and other deductions. Document, document, document. Every receipt or evidence of a financial transaction should be carefully documented and filed. In the event of an audit, it's very helpful to be able to quickly provide the required documentation to the IRS or whatever government body is checking up on your deductions. Luckily, in the digital age, it is easier than ever to keep things properly documented. Just scan or take a picture of your receipt whenever you get one and keep it stored on your computer or phone. Keep everything in order, and you can deduct and save on all your work expenses without a worry in the world. Real estate is where it's at. Your options, if you decide to go the investment route, are extensive and varied. However, there is one area that can earn you that little bit extra in tax savings in almost every country. In fact, if you invest properly and seriously in this area, you should never have to pay tax on your cash flow at all. What is this magical tax shelter? Real estate. The trick is to always be buying more. Here's how it works. Say you begin your real estate investment by buying several single-family homes. You get a nice cash flow from these, you collect your depreciation deductions, and the houses increase in value. However, as you take the depreciation, you reduce a thing called your tax basis. This is the purchase price of the property. When your tax basis reaches zero, you stop receiving depreciation. When you sell the property, you pay tax on your gain, the difference between the tax basis and the sales price. The lower the tax basis, the greater this gain, and therefore the more you will be taxed. You essentially pay back your depreciation deductions in tax when you sell the property. But you can avoid this tax entirely by simply buying another property for the same price as the one you sold. This process, called a like-kind exchange or a Section 1031 exchange in the US, means you can continuously put off paying capital gains tax on a property. This gives you the freedom to sell a property that has become overpriced, or because you simply want to change your investment strategy without getting stuck with the taxes. So those single-family homes you bought have now become a bit too much trouble, lots of maintenance, and you're getting less in depreciation. Using the like-kind exchange, you sell all the houses and purchase apartment buildings for an equal or greater price. You pay no tax for this sale, but now you're enjoying a greater cash flow than you got from the family houses. But apartments still require a lot of maintenance. Now you want an even greater cash flow with none of the work. So, by the same like-kind exchange, you sell the apartments and purchase a retail store which takes care of all the associated expenses itself. Once again, you're not taxed for your gains on the apartments. By this stage, all the depreciation you've been deducting has decreased your tax basis, and, as you might remember from before, a low tax basis equals a higher gain, which means more tax. When you sell, you're going to have to pay a lot in taxes. So, don't sell. If you hold on to the property until you die, your tax basis becomes the same as the value of the property. Pass that retail store on to your children, and they can sell it for its full, tax-free value. While you were alive, you received all the tax benefits from the depreciation, and by holding it until your death, nobody has to spend a cent on taxes. Through the combination of depreciation and like-kind exchanges, a real estate investment really is the easiest path to tax-free wealth.